Good morning, everybody. Welcome back. Our final call of the week. And this morning, we're going to talk about three little topics. We're going to go kind of from micro to macro this time around. And I want to focus on asset allocation, kind of introduce that theme, get that kind of in everyone's head, especially in times like this where there's like a lot of uncertainty. There's a lot of kind of financial mechanisms occurring in the background while we try to prevent we try to prevent a recession while we deal with inflation, while kind of maybe the job market is a little bit in flux, especially in technology. So I want to introduce that theme kind of to everyone's front of mind. Second, I wanted to jump into real estate because kind of dealing with this on a personal level. New York rental market, moving costs, interest rates, maybe buying. It's become really a dynamic space after about 20 years of interest rates near zero and it being kind of this no-brainer winning play. So I wanted to dive into that a little bit. And then last, just a quick commentary from Goldman Sachs's strategy team, where they actually have begun kind of calling it for the U.S. Equity market, for the U.S. stock market, indicating that they think that by the end of the year, we might be near all-time highs. Just to prelude that, I'm not 100% on board, but I find it interesting that they're coming out of the gate and talking about that. So without further ado, let's jump right into asset allocation. And what is asset allocation? It's kind of in the phrase, but what it is thinking about the mix of your wealth. So when you think of your net worth, you can go through what's called an attribution process, which is where you're understanding where your wealth is allocated, where does it come from. A lot of people might immediately think about this as like, well, my job produces income, and that's kind of my main engine. But it's important to, once you feel that you have excess cash, you start building out a sort of diversified asset map for yourself that can kind of survive and live on its own with or without your income or your cash flow. And so in today's world, the typical journey and what we're told is kind of the predominantly intelligent thing to do as we progress through that is generate income, generate excess income, put away some cash. Once you feel you have enough of a cash cushion, start thinking about buying a property. And then after you've bought a property, and some internet gurus, why am I blanking on Dave Ramsey, are kind of dead set on like buy a property, pay out the mortgage, and that's kind of the definition of your entire life. And I kind of want to walk that sentiment back a little bit because this has become more of like a cultural, social construct where, yes, in America, because the mortgage market was securitized, because it became such a popular product for banks, in the very, very early stages, and still today with many programs coming out from the government that improve mortgage conditions or down payment minimums for certain real estate investors, the whole system is geared towards allowing a common citizen, a common person to buy leverage, to essentially get a mortgage, which is a massive amount of debt, to then buy an asset that they otherwise couldn't afford with cash only. So the reason why there is that kind of hyper focus on buying a property as kind of the first big financial step is because it used to be the only major leverage play that a common person could make. You couldn't go to the bank and be like, well, I want to buy $1 million worth of Apple. Will you please lend me money at 4% so I can buy a stock that does more than 10% every year? And they won't go for it, let me tell you. And so that's kind of one of those key elements. There's a little bit of a ritualistic dynamic in the US with buying homes because it gives people access to the most expensive thing they can borrow to purchase. The regular person. Now, if you're a investor, guru, private equity maven, or just really savvy entrepreneur, you can have a business and leverage the business, and you can do kind of slightly more unconventional stuff. But it leads me back to this conversation about asset allocation, where when you think about the pie of assets, you have to think, at least in the term of your life, you have to think pretty ultra long term while you're developing this mix. And it won't always look sexy. right? You know, if you have a well-diversified basket of assets, let's just like spitball here. Some cash, some stocks, some real estate. Maybe you own a business or a franchise as well, so you have some like additional cash flow, some bonds, maybe some physical gold, maybe a teensy bit of crypto or Bitcoin, something along the lines if you want to take the risk, maybe some art. And someone that has a blend of those assets is going to do okay over the long term. They may even beat the market depending on how heavy they weight, you know, some of those sections. You know, someone that invests more heavily in art in their overall portfolio is very high risk, but maybe they'll outperform the market grossly. I don't recommend it. If someone maybe invests overweight in gold, meaning they have a lot of their wealth in gold and the rest is less than that amount of gold, you know, they may not capture the same returns over time that someone who's like 80% US stocks, right? Especially in the last several decades. Looking forward, those things can change, you know, and the world can change so drastically that the person who owns the most gold ends up coming ahead after 20 years of subpar performance. And those are things that happen over the course of a lifetime, over the course of 100 years. I mean, anything could happen. So that's why it's great to think about this asset allocation pie and think about it, at least to start off, in these terms, right? Liquidity. So how quickly can you convert said asset into cash into your account that you can use? So it's the speed of liquidation. So a home in a suburb, maybe a very valuable asset, maybe it increased in price a lot, but the liquidity is not so easy. You know, it'll take you 6 to 12 months to sell the home, even if you've sold it and get the cash. So liquidity is really important. On the other hand, we have kind of risk, volatility. So, you know, you have to consider when you're making that pie, is this asset that I'm buying, does it change in price very aggressively? And am I willing to stomach those price changes, you know, price swings of 20% over the course of a week or a day? Am I willing to stomach my net worth fluctuating that much in this portion of the pie? So volatility risk obviously is a massive piece. And then of course, you know, you have other considerations like, does it produce any cash? Is it cash flowing? Do you have cash flowing assets? That's why people buy bonds, because it gives them a way to lock in a certain amount of cash flow over a period of time. So you spend, you know, $1,000 on a bond, it pays you a certain amount every year, and you know you're going to get that amount until at the very end you get your principal investment back. And so it's a great way to offset maybe some of the other pieces in the pie that have volatility. So cash flow, liquidity, volatility, risk, all of these things, weight, super important, you know, because if most of your money is in real estate and there's some condition that requires you to liquidate into cash very quickly, you may have a difficult time. I mean, the more sort of institutional you are, the more quickly those properties and assets can change hands. But as an individual, you know, you want to be robust. When I think of that, I think of a friend of mine from South Africa who has a Land Cruiser that has like 4 fuel tanks, 2 water tanks, a solar panel, a radio. And, you know, I was kind of teasing him about it, and he's like, dude, if I break down in the middle of the road, no one is coming to get me. And that's very true over the course of an investment portfolio in a life. So we're hitting our time marks pretty well today. I'm not going to lie, I'm a little proud. So final thing to close this out. Oh no, we didn't even get into the real estate section, so I'm not doing so well. So we get into the real estate section, and I want to think about this because we have been dealing with this like on a personal level, like I said in the intro. And I know that a lot of you, you know, in the channel are likely going through this as well, whether it's buying, whether it's selling, whether it's reinvesting in real estate. And I'm not a dedicated real estate expert, but I do quite enjoy some of the, you know, deals I've helped on, some of the scenarios I've been in with some of my clients working in real estate. And it's become really interesting because we're reaching a point, especially if you watched our call earlier this week where we talked a little bit about inflation, we're reaching a point where the buck is breaking, especially on investment properties that are rented out. We've seen prices explode post-COVID, especially in hot key cities. We've seen Airbnb amounts multiply by multiples. And finally, we see it cooling down. Airbnb demand falling, the prices of those Airbnbs collapsing as well, upwards of 40%. Here in New York, extremely hot real estate rental market. Prices have skyrocketed as well, but it's creating a lot of volatility and movement. That's kind of our boots on the ground research that we've had from talking to several brokers. So a lot of kind of people unhappy with the price changes. And it got me thinking, especially if you own a cash flowing property, to think a little bit about what you are asking for rent, right? So typically, a investment property owner will want to continue to illustrate that their rents continue to go up, and that their tenants continue to occupy the properties, and that the rent was always paid on time. This is important to these owners because the more rent they're able to charge on a monthly basis, the more income they can generate over their mortgage if they have one, and it also shows a potential investor that this is the cash flow of this asset. And if the cash flow is greater, the overall value of the apartment is significantly greater, especially if you show consistent growth without interruption in the real estate market. So there's an enormous amount of pressure for real estate investors to keep raising rents, but what's kind of taken a backseat to this post-COVID in particular is that you want to remain consistent as well, because the worst thing you can do is increase the rent, lose the client, have the apartment be empty, and then have to lower the rent. Because at that point, you're sort of giving up value because of mismanagement or poor risk management. So it kind of goes back to that asset allocation piece, risk and liquidity and cash flow. You don't want to threaten your cash flow, because if you threaten your cash flow, you could risk losing months of cash flow and then harming the overall value of your asset. So it's a push and pull, and something that I'm seeing, and I'm getting the leading indication from being an interest rate obsessive, is that if prices are collapsing on the national scale, anyone that's really raising rents aggressively at this point is putting themselves at risk as an asset owner, because the market is telling you that the consumer is saying no. And they're making concessions, they're making not concessions, but strategic changes. They are not willing to pay as much, they are sacrificing things, and it's not a guess. I mean, it's illustrated in the consumer data and in the inflation data. So if you're someone who's pumping aggressively right now, you have to take careful consideration. And of course, this goes all the way down to the micro relationship with your tenant. What's their financial capability, that sort of situation, what neighborhood you're in, who are the employers nearby, that sort of thing. Because you could wind up in a situation where you fill a unit, your rent's very high, but they actually can't really pay it or don't want to, or start looking for a change, and then you wind up potentially in a more volatile, more higher risk situation. So, it's just an interesting dynamic to watch. Of course, this asset class in particular is extremely labor intensive and extremely micro. Like, it really boils down to the specific tenant, the specific landlord, and their own risk assessment of the types of tenants that they want, and prices that they're asking, and the value they're delivering. So it gets very, very in the weeds, but it's just an interesting dynamic to observe, because we're seeing a little bit of a lead and lag on property owners with prices versus what the consumer is doing and what prices are doing across the entire economy. Now, me, I'm kind of a top-down guy. I like to look at the big picture all the way down, but this one sort of merits a little bit of a bottom-up first and then a top-down, because each market is so vastly different. You can't really compare New York City necessarily to Phoenix. Even on a demographic basis, income basis, value of property, churn of customers, it's so it definitely merits a kind of in the weeds, boots on the ground kind of look. Okay, so quickly we'll wrap up here. Goldman Sachs strategy saying that U.S. equities are poised to hit all-time highs. U.S. stocks are poised to do as good as they have ever done. that is the positioning. However, I will say that, I think that they're getting a little bit fast and loose with their calls recently. If you look at the bond market, it's pointing at continued interest rate raises through July, through August potentially. So the divide across kind of the big wig strategists and economists is that whether U.S. equities are going to continue to go up or whether there will be an effective market correction, given kind of where interest rates are, given the consumer may be slowing down as we see interest rates fall, and then the fact that some indicators like interest rate curves, which we're getting into sort of boring territory, but when you see the interest rate curve invert, meaning that the cost of borrowing in the short term is equal to or greater than the cost of borrowing in the long term, it always points at a recession. It usually is like the major red alarm saying you're going to have a recession, you're going to have a recession. So bond guys are a little bit bearish, equity guys are a little bit bullish, and we'll leave it with that. Take care, guys. We'll catch up on Monday.